Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about low volatility trading strategy that can turn seemingly uneventful market conditions into lucrative opportunities. You will learn about key characteristics of low volatility markets and trade strategy methods to trade within them. Additionally, we would cover how to prepare for potential breakouts, ensuring you are ready to act when the market starts moving again. Stay with us until the end of this video to equip yourself with actionable insight and practice techniques that can enhance your trading performance in these quiet times. Now, let's talk about the key characteristics of low volatility strategies. One of the most reliable way to identify low volatility period is by making use of the average true range indicator. The ATR measures the average range between the high and the low of price over a set number of periods, giving you a clear picture of market volatility. When the ATR value is low or declining, it signals reduced price movement, indicating a low volatility movement or a low volatility environment. Now let's look at an example here. When price is moving sideways, you can notice that the ART is declining. Same with this area. When my price was moving sideways, it was declining. It wasn't moving sharply. Let's look for another example. Look at this area when price was look at this area. When price was moving sideways, the ATR was declining. Market psychology during this quiet period also play a significant role. Traders often become less active, leading to tighter trading range and more predictable price movement. This is typically caused by a lack of major news events or economic catalysts, creating a temporary equilibrium in the market where supply and demand are balanced. Like when price is moving in a sideways movement, you can notice that both supply and demand are balanced in this particular range. Timing is another crucial factor for applying low volatility strategy. These conditions are most common during specific times such as before major news, during market holiday, announcements, or in the middle of trading sections when activities slow down. Recognizing these patterns helps you plan your trade more efficiently. Now let's look at how we can trade the range. Range trading. Range trading is a strategy that capitalizes on market moving within a well-defined support and resistance area. When market is moving within a well-defined support and resistance area. This approach is particularly effective during low volatility periods when price tends to oscillate between these two boundaries without a significant breakout. To begin range trading, the first step is to identify a clear trading range. This involves spotting horizontal support and resistance level where the price repeatedly bounce off. Support is the level where buying interest prevents price from falling further, while resistance is the level where selling pressure stops price from rising. As you can see from my screen, I've marked it out. Once the range is established, traders can set up their trades by placing orders near the support level and sell orders near the resistance level. You can place buying orders close to the support level while putting sell trades below the resistance level, sell orders below the resistance level. The goal is to profit from predicting price movement as they move back and forth within the range. It is crucial to use limit orders for precise entries and exits, minimizing slippage. Limit orders help you to minimize the slippage. Risk management is essential in range trading. Setting stop loss order just outside the support or resistance levels help protect against unexpected breakouts. Additionally, traders should consider position sizing carefully to potentially avoid and manage your losses. Now, the second method can be the scalping method. The scalping method is a fast-paced the scalping method is a fast-paced trading strategy designed to take advantage of small price movements in low volatility markets. This approach involves executing a high volume of trade within a high volume of trades within a short time frame, often lasting just few minutes. To capture major price fluctuations, scalpers aim to make small profits on each trade, which can accumulate significantly over time. To effectively scalp, traders typically use momentum indicators such as the RSI. Traders use momentum indicators such as the RSI to identify short-term trade trends and entry points. It is essential to focus on liquid markets with tight spreads to minimize transaction costs and maximize potential gains. Scalpers often rely on tick charts or 1 minute charts to monitor price movement closely. Risk management is crucial in scalping due to the rapid nature of trades. Tight stop loss orders Tight stop loss orders are used to protect against adverse market movement, and traders must remain disciplined to exit position quickly if the market turns against them. Scalping requires focus and quick decision making, making it suitable for traders who can dedicate time to actively monitor their charts. This is an example of the 1 minute time frame. Sharp move. When you see a sharp move from an area of sideways moving market, you can capitalize on it by using your RSI. The sharp move when price break out and you see that your RSI is showing an oversold or overbought area. In case of a buying trend, when you see an overbought region at this area, you can capitalize on your trade, quickly scalping the move, quick in and out of the trade to be as fast as possible. Now, the next way to trade is by the breakout preparation. Breakout preparation involves anticipating and anticipating and strategically positioning the potential price movement beyond established support and resistance levels, particularly after period of low volatility. During these patterns, price move within a confined range price move within a confined range with decreasing volume, indicating reduced trading activity. To prepare for a breakout, traders of ten create a pre-breakout checklist that involves monitoring technical indicators such as the moving average and the RSI, that's the relative strength index, to assess the momentum of the market. Setting alerts near critical levels ensure readiness when the breakout occurs. Proper risk management is crucial. Traders use stop loss order just outside the consolidation range to limit losses if the breakout fails, and adjust position sizes based on anticipated volatility and risk tolerance. By thoroughly preparing and setting and staying vigilant, traders can confidently capitalize on breakout opportunities, ensuring they are well positioned for significant price movement. Let's look for a proper example and show you a consolidation pattern. This is actually a consolidation pattern. You can see in this area, let's use this area here. This is a consolidation pattern. The moment price is consolidating, our ATR is showing a decline in price. As you can see, decline in the volume of traders or volume of people in the market. The volume is low, so the ATR is showing a decline. So after that, once we see a breakout, always remember you can use other indicators such as the RSI to see if, since this is a bullish breakout, the RSI has to tell us that price has been overbought in such areas. And if you look at this area that price really broke out, you can see that it's above the 60. It's above 60. This is reading 66 on the RSI. Shows that yes, it's time for you to enter the trade. You can enter the trade by waiting for price to retest, or you can enter the moment you see your candlestick pattern. This also helps you to not miss out on such opportunities. Let's not forget that we need to put our stop loss at a very good area. Our stop loss should be at a good area to always manage our trade. Put our stop loss below the most recent low or just below the support level. Put it in 2 to 3 pips, 2 to 5 pips below the support level to give your trade some room to breathe. And you put your take profit 1:2 and 1:3 as the case may be. Alright traders, you have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Do not forget to turn on your notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.